There have been a lot of clients have called and asked about inflation. There's a lot of concern that with all the government spending and stimulus that either now or somewhere sooner than later we're going to see inflation come into the economy. But we also have calls with clients asking about deflation. Can you give us your thoughts on the inflation-deflation argument?
That probably is a good time to introduce the principle of loss. Most people, when you talk about loss in capital, they talk about the fact when the market goes down and their portfolio goes down. That rarely is a permanent loss because out of the last 13 to 14 bear markets, the market's made a new high after 6 years, or within 6 years, I should say. The only one that's different is the 29 depression. So permanent loss of capital isn't as big as an individual one-year decline. But the big loss is due to inflation, and that is the greatest loss. More money's been lost through inflation than any other method. Just to give you an example. In the last 30 years, the inflation rate has been 3.68%. In the last 40 years, it's been 4.51%. In the last 50 years, it's been 4.08. In other words, basically 4%. And in the last 96 years, it's been 3.26%. And the reason that's lower than the other averages is because that takes into 29 deflation. So the bottom line is you can figure that in normal times, inflation is going to be 3.5% to 4%. And if you take an average person at age 65 with 20 years of life expectancy, 3.5% to 4% inflation would take their purchasing power to about $440,000. So there is a huge risk in inflation, even during normal times. But if you're speaking about higher times, like some of the people are concerned about the runaway inflation, well, then obviously it's going to be a lot more if it's 6 or 7%. I would say this. Let's take the inflation argument first. The reason that people believe there's going to be a large amount of inflation, more than the normal 3.5% to 4%, is because the government has expanded the balance sheet from almost 2 to 3 times. In other words, what they normally carry in their balance sheet has been expanded. Some people call that printing money. I think you got to distinguish between printing money and creating credit. What the federal government has done is created reserves so that put money in the banks so that they have the ability to lend it out. And as it goes through the banking system, the fractional reserve system, it expands and it boosts the economy and gets things going. If they print the money like they did in Germany, they literally print it on the presses and distribute it, then you're going to have very serious inflation. The government is not printing money. They are creating reserves to extend credit. But if people don't borrow that money, then it's not going to expand at the rate they're supplying it. Also, when the government lends money, they can also pull it back. Now, to give you an example, a classic example is everybody feels we're going to have inflation because they increased their reserves. Yet if you study Japan, in the 90s, they increased the money supply. If you look at it on a chart, it goes straight up. Then it went sideways for a couple of years, and then they drained all that excess credit out. So they didn't print money. They created the money. It expanded. It stood level for a couple of years, and then they pulled it out. And if you look at Japanese inflation, it's averaged about 1.5% during that whole period. So the argument that because the Federal Reserve is expanding the credit, that we're going to have runaway inflation or high inflation does not bear out with the facts. Do I believe it's possible that we could have high rates of inflation like some people worry about? Yes, I think it's possible. And the way that would happen is the government creates this money, everybody borrows it, and then they keep on rolling it out and they keep it in the economy. They never pull it back. If they never pull it back, we would have high rates of inflation. And so those people who are worried about it, they're thinking, well, the government is not going to pull it back because when you pull it back, it slows the economy, could cause a recession. They're not going to want to do that politically, so they're going to keep it in there, and that's what's going to create inflation. Our point of view is they're not going to keep it in there, and I'll tell you the reason why. And this is what made me change my opinion about runaway inflation many years ago to now. And that is that if Europe and Asia sees us creating this money and creating inflation, they're going to say to America, we're not going to hold your dollars anymore. And if they didn't hold our dollars anymore and the dollar collapsed, we would have a crisis that would be worse than inflation. So because of the fact that the U.S. government let the world down in the 70s by literally printing money, which is what Arthur Burns did in the 70s, that created that 12 to 15% rate of inflation. We were on our way to runaway inflation. And that's why I've always said the crisis in the 70s was worse than the crisis today, because we don't have runaway inflation. If anything, we have a little deflation. But that's a lot better than runaway inflation, because once you have runaway inflation, you destroy the fabric of society. People don't trust each other. The government has to tax you. They create price controls, and people have to work around that, and creates all kinds of graft and payoffs and payola. And you have all the problems of a third world country. So we are not going to go into runaway inflation, not because it's not possible, but because of the fact that the government knows that if they do it, then we're really finished, because it'll collapse the dollar.
So for the next 3 to 5 years, would you say we're going to be in a lower inflationary environment, and then eventually we'll have higher rates of inflation but not runaway? How would that scale work in your mind?
Let me just say one thing about forecast. You don't want to ever forecast things, because you don't know how people are going to react and what the government's going to do and so forth. And that's why forecasts don't work. It isn't that if you had all the facts and you laid it out and you look at the facts that it wouldn't work out that way. It's just the variables change. So forecasting is not a good idea. But just based on the facts, in order to have inflation, you need to have low unemployment, which allows people to raise wages, because wages are a big component of any product that's produced. So the first thing you got to have is you got to have low unemployment. We have high unemployment now, and according to the statistics and the way they're adding to the job market, it's going to take 3, 4, and 5 years before you get back to a normal employment market. That's one. Number two, the factories are running at 72% utilization. They're not going to raise prices when they don't even have enough customers to keep the factories going. So when those factories are running at 83 to 85%, then people start raising prices, and you'll have a little more firmer inflation. Now, that's 3 or 4 years away. So I think when you look at all the factors, it's safe to say that even if we're going to have higher inflation, it's not going to be a concern for 3 or 4 years. And so that argument will tell you that, yes, you can have inflation, but the probability is, and it's only a probability, that it'll probably not be high for 3 or 4 years. After that, we can have much higher rates of inflation depending on how the government handles that credit that they've extended and how quickly they're willing to pull it back.
Now, we've written about inflation, and we've shown 8 different statistics or metrics in our newsletters over the last year, and so we're going to continue to keep everybody informed with these gauges to see where the pulse of inflation is, and if it changes, we're going to be sure to let everybody know.
Right. And I would say right now, if we were to update these inflation gauges, none of them are suggesting. There's some that are neutral, but none of them are suggesting inflation. Matter of fact, what these indicators are saying is there's a greater risk of deflation. Not that I'm predicting it, but if I had to bet, I bet right now that in the next 2 years, we have a greater chance of deflation than we do inflation. Over the long term, I don't think deflation is a factor to be concerned about at all. But if you were going to bet, I'd bet more on deflation than inflation. Fortunately, with the way the economy is recovering, with the way the companies have repositioned themselves, we probably don't have to worry about serious deflation. What we may get is very, very low rates of inflation, which actually is a very positive. So from that standpoint, I'm very positive about that, not having to worry about inflation for a few years. And I don't think we have to worry about deflation because of the government's ability to create the extension of credit and injections of help in different parts of the economy to prop things up.